Joining us now is Daniel Lacalle, Chief Investment Officer at Tressis. Daniel, thanks so much. We're just getting an update from our reporter there on the political situation in China, but I'm really struck by the first line of one of your recent notes on China, saying that the Chinese slowdown is much more severe than expected and not only attributable to COVID-19 lockdowns. What does that mean, Daniel, if somehow COVID-0 were to be abandoned tomorrow, which I know is unlikely? What are the economic issues that go beyond that just lifting lockdowns wouldn't solve?
Hi, good morning. Yes, the main problem of China is the real estate market. If we look at the size of the real estate sector, directly and indirectly, it's about 29% of the GDP of the country. It is virtually impossible to offset the slowdown of the real estate market, even in the most benign economic circumstances, with any other sector. And I think that that is the largest problem of the Chinese economy, added to the fact that after a chain of stimuli in the last 10 to 15 years, the country will not be able to achieve the levels of fiscal multipliers that it got from previous stimulus packages. So a slowdown in the real estate market that is much more severe and less COVID related than one would imagine. Also the crackdown on the tech and retail sectors that will continue even if the lockdowns are lifted. All of those factors significantly reduce the level of growth of the Chinese economy.
Good morning, Daniel. So, I mean, the concerns about the real estate sector have been a kind of perennial issue for several years. And the hard bit for many people in the rest of the world is how to trade when this really becomes problematic for their economies. And I guess in that context, how do you kind of rate the overnight news about potential stress at Greenland Holdings, which is a quasi-state-owned enterprise, and that's showing concern about paying some of its debt? Do you think this is another sudden escalation point, or do you think it's still going to drag out over many months or years?
I think it's basically a symptom of all the challenges that we have been discussing. More importantly, I think that it'll I think it'll drag on for a few months at least. I think that the banking sector in China is pretty well prepared, and the government is certainly directing to a certain extent the slowdown so that in order to avoid what would inevitably be a chain of significant events in the credit market. That is not something that we are concerned about. We think that in terms of liquidity and in terms of the coordination between the banks, that is pretty much contained. However, it is going to go on, in our opinion, for a few more months.
I do wonder, Daniel, when the rest of the world is looking at China and looking at the implications that a slowdown in that economy would have for the global economy, are we correctly assessing that risk? And if not, what would correctly assessing that risk look like in these markets?
Well, if we look at consensus estimates for GDP growth for 2022 and 2023, the biggest challenge to those estimates comes from two factors. The first one is a very benign estimate of the end of the impact on inflation of the Ukraine war and supply chain disruptions. And the second, obviously, is much stronger economic growth from China in the second half that looks more and more unlikely. So if you look at what would the normal situation in China, and even what the messages coming from officials would dictate to us, you would basically have to shave off about another percentage point of global growth from consensus estimates. So it's quite a significant, let's say, downgrade what we have in front of us. But, and I think that this is the key, if we can say bullish factor, this still does not lead the global economy to a recession.
Okay, Daniel, stick around with us. Much more to cover. Daniel Lacalle, Chief Investment Officer at Tressis.